Crowdstrike just reported their latest quarterly figures, and it does seem like the July 19 event just happened and that's it. Because it's business as usual for Crowdstrike. An excellent quarter yet again, proving yet again that, well, this company is worth the premium. Funny enough, before they reported earnings, the stock was basically back to where it was prior to the July 19 outage. That's over an 80% recovery since the lows here at the start of August, which is quite something. Now at the time of making this video, after hours, the stock is down 5.5%. We'll explain in this video why that is, but all in all, if you purely look at pricing metrics, of course, this is not a cheap stock, right? Forward PE close to 100 times, EV to sales next 12 months 20.1 times, EV to EBITDA 87.1 times. Now, yes, this is a company that is expected to grow top and bottom lines quite fast for the coming fiscal years, a healthy free cash flow margin, rule of 51, I believe. So a tremendous company to own, but definitely not a cheap one, which you can see right here. Forward PE might be lower than the 5-year mean, but the 5-year mean sits at 127.9 times. So yeah, was never really cheap. Same for EV to EBITDA, price to sales, price to free cash flow. That's in the last 12 months. That's the, let's say, cheapest metric here, just 76.5 times, but free cash flow is expected to grow in the next 12 months. Then price earnings to growth, 2.88, which of course is expensive. And at the time of making this video, which is before all the analysts are going to change their price targets, the average analyst price target does sit 6.2% lower than the price we're at today, which now after hours is going to be, well, close to that number. So what exactly has happened this quarter? We're going to cover that, and we're going to do a quick reverse DCF as well at the end of this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so a quick overview here by Stock Market Nerd on X. You can basically see what the market was expecting and if they beat or missed it. Well, for the quarter, it was basically a beat across the board for all of the important metrics. The Q4 guidance was, well, a slight beat on Q4 revenue estimate and slightly beat its identical guide. Now, it is slightly missed Q4 EBIT estimate and slightly missed the EPS one as well, and probably that's why the stock is down, because Q4 is usually their best quarter. Now, all in all, if we zoom out, this is a company that is growing and has been growing quite quickly. Free cash flow is also expected to reaccelerate. For fiscal 2025, it's expected to grow just 10.9%, but then in fiscal 2026, it's expected to reaccelerate to grow 26.9% and then grow even faster in fiscal 2027 by 35.1%. Zooming out even more and looking at total revenue by geography and annual recurring revenue with the updated numbers right now. I mean, since January 2020, total revenue has increased by 564.1%, and this was the first quarter where total revenue came in above $1 billion. As for annual recurring revenue, first time that number is above $4 billion. What's even more impressive here is remaining performance obligation. We can see an acceleration in growth. Last quarter, that increased by 36.1% year over year. This quarter, 46% to now $5.4 billion. So, all in all, what do we have? We have ending ARR just above $4 billion, net new ARR of $153 million, an operating profit of $195 million with diluted EPS of 93 cents. Free cash flow for the quarter was $231 million, which is better than what the analysts were expecting, a free cash flow margin of 23% and a rule of 40 of 51. Now, depending on what you're looking at, you might see that EPS is going to be negative. That's because total operating expenses has increased quite a lot, which I'll go over in just a bit. Overall, the module adoption rates are increasing. I mean, 66% for the 5 plus modules, 47% for the 6 plus, 31% for the 7 plus, and 20% for 8 or more modules. I believe they also said that they had over 97% gross retention. So I mean, yeah, customers definitely see the value in the Falcon platform and well, the overall business. As for the growth rates, ending ARR increased 27% year over year. Subscription revenue increased 31% year over year. Net new ARR is down for this quarter. If you look at the 9 months ending, it's down a little bit, but not by much. Total revenue overall is up 29%, well, closer to actually 28.5% year over year. And for the 9 months ending, that's up 31%. Now, subscription might be up 31%, but professional services, as you will see, is actually down. For guidance, we've seen that before, but this is basically the major overview for Q4 and for the full year fiscal 2025. Then if you dive a little bit deeper, you will see all of these numbers. So total revenue increased 28.5% to be precise. Total cost of revenue increased more, 30.8%. And here you can see in the revenue, subscription increased very, very nicely, as we've seen, 31%. Professional services did decrease this time. Now, what we can also see here is that while total operating expenses is up close to 38% year over year, that's also why you are seeing here net income go from net income same quarter last quarter to now a loss. Why is that? Well, because in operating expenses, you are now going to include extremely high SBC, July 19 cost, amortization of certain intangible assets, and also acquisition expenses. All of that have increased all of these things here. And so we're seeing total operating expenses increase much more than expected. But of course, we don't expect most of these things to happen every single time. So it's always nice to look at the core business, excluding all the one-time charges, acquisition related expenses, and July 19 costs. Well, hopefully there's not going to be any other July 19 event. Now, if we go and look and do a quick reverse DCF, we can plug in the numbers. So free cash flow trailing 12 months, $1.146 billion, plug in the terminal growth rate, 4.4%, discount rate of 8.44%. How do you reach that? Well, basically, the terminal growth rate I take from the 10-year yield. So that's basically the market telling us that this is the risk-free rate. And then you add on top of that the implied equity risk premium. You get that number right here, 8.44. I put here a 2% dilution for the next 10 years. So the implied growth rate to justify today's price after hours is 20.4%. They have to grow free cash flow 20.4% for the next 10 years for it to make sense to trade at current levels. Now, as we've seen for fiscal 2025, which is ending for them pretty soon, free cash was expected to grow around 11% or so. But then what we've seen is that for the next 2 fiscal years, it's expected to grow quicker than that 20.4%. But then again, is it going to continue to grow more than 20.4% after fiscal 2027? That's the question. If you think so, then okay. Then this should be a buy the dip opportunity for you. If not, then you might be waiting for it to dip even further. Now, actually, let's have a look at the charts. Because right now, as you can see, a very, very nice recovery from the lows around $200 or so back here at the start of August. Right now, if it does stay like this, it's probably going to open maybe a little bit lower. We might see if we get a rebound at the 20-day moving average, which is at $338. If not, look down below, the 50-day moving average at $316.9. And if that doesn't hold, then you might get an even better buying opportunity under $300 at $294. RSI is high, but nowhere near being overbought. So we'll see. Maybe you might get a better buy the dip opportunity here. But all in all, I mean, this basically shows you, right, how important, how good of a business Crowdstrike is. An extreme outage that happened, an extreme event that happened, and yet the business is, we can call it firing on close to all cylinders, right? So yeah, that's usually when these things happen and you come out of it much stronger, well, then you probably know that you have one of the best businesses in your portfolio, right? So that's basically Crowdstrike here. I don't own it personally. Yes, I'm sure that a lot of you do. Cybersecurity stocks will do quite well in the future as well. I'll probably cover Palo Alto as well, because now that I remember, I did not make a video on that. They also announced a stock split, Palo Alto, not CrowdStrike. So we're definitely going to cover that company in the next coming days. All in all, that's the review. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.